You hear a lot of people saying, okay, American exceptionalism is dead, the dollar's demise is upon us, and first half of the year, biggest decline in the dollar since 1973. That was all true. But we believe that the return on invested capital in the United States, because of the deregulation and tax changes, return on invested capital in the United States is going to increase relative to that in the rest of the world. That's dollar positive. I think many investors in the United States are very focused on the short term. Our investment time horizon is 5 years. If you don't understand something, if you don't develop conviction around something, then don't invest in it because you'll be a weak holder. I think that we have just begun. Because, as I mentioned before, we're hitting prime time in so many of these technologies.
Cathie Wood is arguing that we are in a very healthy bull market that is climbing a wall of worry and, most importantly, beginning to broaden out. She contends that beneath the negative headlines, provocative and powerful pro-growth changes are taking place in the United States. The key catalyst she identifies as a massive, under-the-radar corporate tax cut embedded in recent legislation, which allows for the full expensing of R&D, software, and equipment in year one. This, she calculates, will drop the effective corporate tax rate from 21% to the 10 to 12% range, supercharging the return on invested capital and making the U.S. the most attractive destination for investment.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
We're listening to the markets as well. This market, the stock market, is climbing the proverbial wall of worry. And it is broadening out. In fact, that concentration towards the Mag 6 is starting to broaden out. That's a very strong bull market. Now, why is this happening? Yes, the headlines blare negative news, as you say. It seems to get a lot more attention. If you look under the covers, at least in the United States, there are some provocative changes taking place in terms of deregulation. I don't think people understand how much deregulation is taking place in the U.S. In every industry, and then the one big beautiful bill, OB3, we've nicknamed it OB3. Underneath those covers are tax cuts that I don't think many people, even in the United States, understand because they're mostly focused on the corporate sector. And they're allowing full expensing of structures, equipment, domestic R&D, and software in year one, first year of service. That is taking the effective tax rate in the United States from 21%, where it is today. This is effective. It'll still be there.
This is corporate tax rates.
This is corporate tax rates, 21% down to 10. So it's in the 10 to 12% range. Some of the lowest in the world. And so you hear a lot of people saying, okay, American exceptionalism is dead, the dollar's demise is upon us, and first half of the year, biggest decline in the dollar since 1973. That was all true. But we believe that the return on invested capital in the United States, because of the deregulation and tax changes, return on invested capital in the United States is going to increase relative to that in the rest of the world. That's dollar positive. That is dollar positive. So I think that's why the markets are powering forward in the U.S. Investors had rebalanced during the boom, the 150% increase the year before. If every time we had reached, let's say, 5% of their portfolio or 7% of their portfolio, they had rebalanced to that original 5%, then they would have done really well, even with that drawdown. And we are certainly going to be out there educating a little more aggressively this time than we were the last time, if that happens to us again. The way I like to characterize what did happen, boom, bust. The bust was worse than the NASDAQ sell-off after the tech and telecom bubble. That should not have been, because the technologies are ready and the costs are low enough. DNA sequencing costs in early 2000s, $2.7 billion to sequence one person's genome. Today, $200. We're going to get a lot more of it. So it makes no sense that that happened, but that just increased our conviction that we had become a deep value portfolio. And so the way I like to characterize, boom, bust, if you look at from inception, this is U.S. portfolio now, U.S., because that's the only one that's been in place for that long. From our inception to today, our compound annual rate of return has been 15%, even with that bust in the middle of it. So that gives you a sense, and I think that we have just begun. Because, as I mentioned before, we're hitting prime time in so many of these technologies that I think the world is our oyster. I don't want to be too comfortable in saying that, and we do. As I said, the valuation is back at a premium. We assume compression. We assume it in our assumptions, and our rate of return expectations are, well north of 15%. If you don't understand something, if you don't develop conviction around something, then don't invest in it, because you'll be a weak holder. All we do is technologically enabled innovation. So we're a great complement to a Warren Buffett strategy, because we know what these technologies are going to do. And so I would say diversification is a very good thing. Sure, value, growth, we'd be on the growth. We'd be a great complement to those sorts of strategies.
The centerpiece of Wood's thesis is that this new fiscally stimulated environment will fuel a great broadening of the market, marking the end of the 2-decade trend towards passive, benchmark-sensitive investing. The pendulum, she argues, has swung too far. This shift will be driven by a critical divergence. The largest, most dominant companies in the major indices are now themselves facing existential disruption. She points directly to Apple's well-documented struggles in the AI and autonomous vehicle space, Google's eroding search monopoly in the face of new AI-native competitors, and even Amazon's potential disintermediation by agentic AI personal assistants. These tech giants, once the engines of growth, are now becoming vulnerable incumbents.
We are not, in the top 10 of our portfolios, you will not find the Mag 6 for the most part. They might earn their way if they do very well in this new age. And the reason is we're focused on the purer plays. There are a lot of high expectations for this new world in the Mag 6. And we're hearing already Apple, a lot of controversy around its AI expertise. We have been worried about that for 6 to 7 years, because we've watched Apple, which should have moved into the ultimate mobile device. What is that? Robotaxis. And they tried. And they had one management turnover after another. Robotaxis, we believe, are the largest AI project in the world. And Apple, by all rights, should have been there, given its focus on hardware, on mobility. But they couldn't get it right because it's an AI project. And I don't think they were able to hire the right kind of expertise. Or, from another point of view, even now, they have put their AI strategy under the former head of Vision Pro, which wasn't really a big success. This should be coming from Tim Cook, the highest levels. And so they haven't done that yet. Apple, we have been concerned about their AI expertise. All of the others, they have been extremely successful, right? So they're at the top of these indices, all of the broad-based indices. And that means historically they've had a lot of success. Our focus is on truly disruptive, technologically enabled innovation. And so if we're right on that, there's always the possibility that past successes, which created duopolies, almost monopolies, are going to create problems for them. Now, we were actually very surprised at how quickly Google is reinventing itself. It always had the best AI researchers in the world. It bought the UK's own DeepMind, right? And now it is starting to get with the program. We're quite impressed at, they're in the full stack of AI, from chips, TPUs, to the cloud, GCP, to large language models, Gemini. And so we're very interested in what they're doing, I have to say. Amazon agentic AI is going to challenge it to some extent, because this idea that we start our shopping experience at Amazon may not hold true as much in the future, but they'll probably be like the Walmart of retail in the future. Meta platforms, we thought, oh my gosh, they're doing such interesting things. This open source strategy in AI and large language models was working, and then it didn't work. It wasn't keeping up with even Grok XAIs. So we're wondering what's going on there. We think it's going to be winner take most, and we're already seeing victims. So this acqui-hire strategy that especially Meta Platforms has now, Mark Zuckerberg is plucking talent, usually the CEOs, out of companies, LLM companies that are probably not going to make it. So we're already seeing that a number of companies are giving way to the big four, which would include Gemini as well. So yes, we do think, and the amount, and if you look at what's happening as they're leapfrogging one another, OpenAI has stayed really ahead, but to watch Grok or XAI in terms of the large language, to see it shoot up ahead of OpenAI in February, OpenAI then leapfrogged, but to see that happen so quickly, even before Anthropic and Meta, Llama, was very interesting. So this is the big race, and it is winner take most.
And so I guess you having multiple positions there is a hedge, as opposed to obviously conviction that all three can win to the same extent.
And they can develop expertise in different kinds of LLMs. So Anthropic was coding. Now OpenAI wants more of that market. I think XAI is going to be a very interesting one to watch, because this is key. What is going to be the defining factor in who wins almost anything in AI? It's proprietary data. And when you think about XAI, you think about all of Elon's companies and all of the disparate data that nobody has. So the Tesla data, Neuralink, AI is patterned after the brain. Neuralink getting a lot of information there. SpaceX getting data that nobody else has about space. And even Boring Company, tunneling. So these are disparate forms of data. Everybody thinks it has to be just text and the internet. No. There's pattern recognition. This is all about pattern recognition. So we think that's the sleeper.
This coming disruption of big tech is precisely why Wood believes true. Technologically enabled innovation is poised for a breakaway move. Her strategy is not dependent on expanding valuations. Her models assume multiple compression and still project returns far exceeding their hurdles, driven by sheer fundamental growth. The future, she asserts, lies in the winner-take-most AI race. She sees a sleeper contender in Elon Musk's XAI, arguing that its access to a unique and disparate set of proprietary real-world data from Tesla, SpaceX, and Neuralink provides the ultimate competitive advantage. This underscores her core belief that the next decade of market leadership will come from actively identifying the true disruptors, not the passive benchmarks of the past.